Hi guys, Melissa McNana here. I want to talk today about indexed annuities. Many people don't understand how an annuity works or how an indexed annuity might be different from a variable annuity. So I wanted to go through this slideshow presentation. I'm going to go fairly quickly. I will not read every line item on the slideshow. If you'd like a copy of it, message me. I'll get you a PDF form of all of the materials. This carrier is one of our carriers. As an independent agent, I can represent many carriers. Some of the features you will see in this particular slideshow will be about EquiTrust products specifically. However, the basic workings of an indexed annuity are the same across the board. So, like EquiTrust, they have some great products, but I also have other carriers available if some of these specific features don't meet your needs. So, are any of these your long-term objectives with your money, whether it be your retirement money or other discretionary funds? Do you want upside growth? Downside protection. That is one of the main things about a fixed or fixed indexed annuity, is that the principal is protected. There are many products that offer a good deal of liquidity, and there are tax advantages. Annuities grow tax deferred. All annuities, not just EquiTrust annuities. So an indexed annuity is actually the gains, instead of being at a fixed interest rate, are based on an index such as, in this case, the S&P 500. There's many other hybrid indexes. We could go over those products specifically if you'd like when we have a discussion one-on-one. The S&P is usually used for presentations like this because most people have heard of it. They kind of understand what the S&P is, that it represents the top 500 companies, and instead of following an individual stock, how it goes up and down, the index follows this group of stocks to kind of give you an idea. Here is one of our really good charts. You can see that if you had your money directly in the S&P, in 2008, it went down significantly. A lot of people who had money in the market are familiar with this. A lot of people lost half of their 401k. The problem with losses is if you lose 50%, you have to have 100% gain on that money to get back up to even. The way an indexed annuity works is when the market goes down, as you can see there in 2009, the indexed annuity didn't show any gains, but it did not participate in the losses either. Their account just stayed level. Then, as the green line there, the S&P starts coming back up. It's coming up from a much lower point, where your brown line, your index, starts to go back up in the same sort of pattern as the S&P, but you're at a much higher rate. You can see that there's generally caps. You won't participate in all of the gains because you have that downside protection. That's your cost of the downside protection. So you see up there in, say, 2018, where the S&P did well, it actually exceeded the gains of the indexed annuity. But then when it went back down the following year, you still came out ahead because the gains in the indexed annuity stayed level and were locked in, and you did not participate in the losses. Most indexed annuities offer a variety of different type of indexed accounts. You can do annual point-to-point, some averaging. You can do them with participation rates or with caps or spreads. So as we discuss what is right for you and what product's right for you, we would discuss the strategies available in that product, how they work, and which one might best fit your needs. Here's an example of how it might work on a point-to-point cap. If you had 3% index growth, you can see that it would be credited to the account over there on the side as a 3% return. Example 2 shows a 15% growth, And example 3 shows a decline. Now, I think my picture is there in the way, so you may not be able to see exactly what it's showing you there, but on the number 3, it just shows you that you have a 0% credited, so but no losses. Now, how do various rates affect an indexed annuity? Well, if you have participation rates for index accounts, that's how they can afford to buy their options. Renewal rates are at your anniversary period. You will see that you will have an option to change allocations. If you wanted to change from, say, a monthly point to point to an annual, or from an S&P to, say, a Barclays, or even to the fixed account, you have those options, and they will give you the renewal rates in plenty of time to let you make your decision about how you might want to do that. Now, your minimum rates are contractually guaranteed, and they're established at the beginning of your contract. Therefore, you won't be surprised that they'll suddenly go to a rate that you're unexpected. Now, there's also some guaranteed returns in some of the built in some of these annuities. All of them have a minimum rate guarantee. They're different by states sometimes. In Arkansas, most of the time you're guaranteed a good 3% on like 87.5% of your money, and that's worst case scenario, even if the insurance company went out of business, which is highly unlikely. Most of the time your fixed account will have a bottom rate of 1. Sometimes we've seen it as high as 2 or 3. So depending on your guarantees, there may be other features that are available or not available in the product. Tax advantages. Say you have your money in a CD, for example, you pay interest annually, whether you take that money out or not. If you just rolled all of that money into another CD, or if you had a savings account where you were earning probably these days about 1/4%, you have to pay taxes on your earnings regardless of whether you spend the money or not. Now, in an annuity, you have the tax advantage of deferral. So you do not have to pay taxes on your gains until such time as you take the money out of the annuity. So if you leave it in there for 10 years, you could experience 10 years worth of gains prior to being taxed on that. And there's some ways that we can help you as you're taking the money out when it's time, whether it's for your retirement income or other needs, to help you sort of structure those withdrawals so that your money is not being taxed in an unfavorable way to you. A lot of people find that when they get older, they have a lower tax bracket, so sometimes putting off paying taxes until you're in a different bracket can be advantageous. Here is a chart that shows you the different types of savings products and generally the features available. The one thing I don't agree with on this grid, a lot of your variable annuities do offer a lifetime guaranteed income that will come in the form of a rider, and you will be charged a fee for that. Now, with an indexed annuity or a multi-year annuity, you can annuitize all of these products without a fee, and many of them also have income riders available with or without a fee depending on the product, and you are able to generate an income that you cannot outlive. You can't say that for your stock market or your savings bonds or any of those other things. So you do have safety of principal in a lot of these products besides the annuity, with the exception of your variable or your stock funds. But you don't have the advantages, all of the advantages of the annuity, or whether it's indexed or fixed, because you have the ability to defer the taxes, you have the principal protection, you have the lifetime income, and no other product, not even your multi-year fixed annuity, guarantees you all of those things the way that the indexed annuity will. Income riders. A lot of people don't understand what these are. When annuities were really popular before, they were pretty plain Jane and they didn't have a lot of optional riders or different features. An income rider is a way to begin an income stream without losing control of the money. When you annuitize an annuity, most of the time you lose absolute control over the money. It's an irrevocable income stream. What they do is they take a lump sum and they transform it into a lifetime income stream or an income stream for a set time, say 5 years or 10 years. And that income stream is then irrevocable. The income rider is sort of a solution to that for those people who wanted to begin to draw an income but were unsure if they wanted it to be forever and were unsure if they wanted to give up their ability to take additional withdrawals or other features of the product. So an income rider will give you some predictable income. Most of them are really flexible. You can begin them and stop them. You can pause them for a little bit. Many of these income riders are available in single or spousal, the ones with EquiTrust are. A lot of them also offer some additional enhanced benefits, increases in income if you are in a nursing home or if you have some other terminal or chronic illness. Now, an income rider is, again, a way to do this without giving up control of your annuity. Most of this stuff we already covered. You cannot do your income prior to age 50 with most carriers. In fact, I don't know of any that will allow you to exercise an income rider younger than that. It's not usually tax favorable to do that. If there are some exceptions to that, and if you meet one of those exceptions, we can definitely talk about it, but we don't want you to incur the additional tax consequences on the gains by taking the money out too early, because annuities, like other long-term vehicles, they're intended for retirement, and the government doesn't want you taking that out too early and not having enough left over, for what the purpose was, so that you won't outlive that income. And of course, the earlier you start the income, the younger the age, the less mortality factor you have on there. So the payment will be less than it would be. So a lifetime income starting at 50 will be considerably less than someone who waits till, say, 70 to take it on the same amount of income. So you have a percentage called your income withdrawal percentage, what I was just talking about, and then it'll be based on your age, and it'll be contractually guaranteed at the time you take out the annuity. These things change from time to time with carrier to carrier, so I can't tell you what the lifetime income factor is for a given age because that's product specific. And as we talk about your current situation and what might be right for you, we could find one, and then of course if you lock that in when you wrote the contract, it would be set that way regardless of changes to the product later. So then your income base will be what they call a benefit base, and it will be based upon a roll-up, which is a formula they use to give you gains on the income base that do not go to your account value. Could be bonuses, could be a number of things. Some of them are participation based, which means as your index grows, they grow instead of a set amount. So again, there's many ways we could structure that. So they take your percentage based on your age, whatever your benefit base has grown to, and that's how they figure your dollar amount for when you start the income. Now again, it's a guaranteed lifetime income on these income riders, so you cannot outlive it. If your account value goes to zero, you are still getting those income payments for the rest of your life, and that can be very crucial to someone who maybe can't live off of Social Security or has other needs and wants to make sure that their money that they've been able to save doesn't run out before they do. Now, how is your spouse protected? If you have a spouse and you have a joint account, you can do a joint income. A joint lifetime income is generally a little bit less than what you would see on a single income because they'll use a different payout factor. but then it will pay until the second person passes away. The other way they can be structured is for you to have your spouse just be your beneficiary. In that case, he or she will only get the residuals left over from your policy that's left in the account value. So that'll be your account value less income payments you've already taken. So sometimes that's not the best way to take care of a spouse. But if you want to make sure that you have a lifetime income for both of you, you can select that joint income option. So again, we're talking a little bit here about EquiTrust, but these apply to most other carriers. EquiTrust is a great carrier. They have a great roll-up factor on their products. They do have some bonuses and some decent crediting rates and options. So if you'd like to learn more about EquiTrust annuities or indexed annuities in general, to see if one might fit for you to help you protect against running out of retirement income, give me a call. I'd love to visit with you further. We can discuss your specific needs and find the specific product that might work for you.